40 years ago, that you're building cash flow, and commercial and resi is like another business. Treat it like a business.
Yeah.
It's an investment business.
All about return on investment.
Yeah.
And I think, the return on investment is more crucial than your capital growth, because if your return on your investment is protected, respects to the lease covenant, your outgoing recoveries, you're getting your projection of growth increases, that in turn increases your capital value anyway.
So hi everyone, I'm sitting here today with Paul Di Mauro. Paul runs a great commercial business with us in the city. So any questions after today, make sure you reach out to Paul and he'll set you straight on ins and outs of commercial and buying commercial property. So Paulie, we were just chatting earlier about some of the pros and cons of commercial. And I think today's process, just having this casual coffee as we sit and have our lattes and espresso, it's good Italian, you're having your espresso. You don't need to have just espresso, is around sharing with people what commercial property is, meaning a couple of things like how do you get started, what it means, different leases, and to give you a little education. So a lot of us, including myself, I was saying to Paul earlier, I've owned a few retail shops for our businesses over the years, not really knowing what I was doing, except I remember my dad said, who had a little dress shop, he said, secure your presence, buy your shop, and do that, which is what I did. Now, I bought them, sold them over the years. And then later, last year, in consultation with Paul and a buyer's agency as well, I found a really large site in Perth, which was different. It had service stations, shops, different things. But I knew nothing about it until then. And I slowly got this far because my focus was on residential. And what I realised, though, so many investors don't understand what's happening in the commercial space, how you can get involved, what the yields are, what the risks are. And today, as part of that, is to open your mind, because you could be an old bugger like me that has been slow to learn around the commercial but realise he really loves it, or someone that is young and building a resi portfolio that eventually wants to add some commercial. So we're going to open your mind to it today. Of course, any questions you have after today, flick us an email, get Paul to answer them for you. And of course, you'll have Paul's details. You can always reach out to him because Paul manages properties everywhere as far as Tasmania.
Yep.
So it's great chatting. So Paul, let's just talk about yields.
Yep.
And I know it can vary. Like example, the yield I've got in Perth, which is quite high, which is 7% now, and that's a net yield for all you people listening. And I don't understand what that's net. Where resi might be 4.5% yield, but after you take out costs and pay land tax, it might drop 2.5%. This is the net yield because my tenant, wait for this, everyone, don't be shocked. My tenant is paying the land tax, is actually paying my agent's fees, is paying the insurance on the property. So that is the net yield. Now, of course, you need more money. I think, Paul, they say it's around 35% you need equity, whether from your house, your other investments, or you put the cash in when you're buying commercial. That's what banks want. Are you finding that sitting around that?
Look, traditionally 30% is the benchmark, but in some cases you can even go to 20, depending on collateral, to assist with the purchase. But yeah, 30 is usually the benchmark.
And what are you sort of seeing, obviously, around? I know city's different, and yields are a lot lower in Sydney.
Yes,
because it's generally people may be thinking higher capital growth, and there's more demand for commercial. But what are some of the yields you're seeing that is available if we a broad market from some of the areas where you manage property, and that could be from Tassie as well?
Yeah, look, I mean, generally speaking, in the core markets that we focus on, in the NOS markets, the yields are a lot more compressed, depending on what the asset is. But traditionally, it's between that 4 to 5% net as a benchmark.
And that's around the city sort of areas in a west.
In a west, city fringe markets.
Sydney, yeah.
Correct. Further out, if you start going towards Newcastle, Wollongong, you're going to be finding yields more so around that 6 to 7%.
Yeah, which is great. If, like in my case, we were saying earlier, the property that I bought, my interest rate 6.2, but the yield's 7. So I'm cash flow positive, and I borrowed 100% on this particular property.
Yes,
which is phenomenal.
Yes, and you want to be in a positively geared position on those assets.
Yeah,
to allow for those shortfalls, vacancies and whatnot.
So on vacancy, which people wouldn't understand, like I was speaking today earlier with Frankie from my Manly office about resi. And typically, you know, it's 10 days, 2 weeks, which is resi and Manly, of course, because Manly's Manly. But I know in commercial you could be 3 to 6 months without a tenant. You've got to allow for what are you finding around your areas?
100% correct there. Like the usual vacancy rate, with property becoming vacant, securing a tenancy, allowing the time frame to also take into consideration the incentive deed that comes with finding a tenant. So, you know, a normal...
Just before we go on to that, just hold that thought around incentives. So I want to come back to that, but yes, talk about the time, but let's come back to incentives.
So timeframes are usually, in my experience, could be between 5 to 6 months, in some cases longer, depending on the type of asset and where it's positioned. But you need, at a minimum, to allow for a 6-month period of vacancy, I'd say.
Now, on incentives in commercial, it's quite common where they might get a rent reduction or they might get a rent-free period. Talk us through what is sort of normal within the industry. What's good and what's bad if you're a landlord giving an incentive?
Oh, look, I mean, landlords, traditionally speaking, don't want to provide any incentive.
We're tired, aren't we, us landlords?
We own the property, you're coming in, so you pay us the rent. But in the commercial world, when securing a tenant, the incentives really range depending on the lease terms that are secured. So the larger the term and the better quality of tenant, if it's a blue chip tenant, say it's a national operator coming in, like a Charlie's.
Or a Woolies or Coles or whatever.
One of those operators, they'll traditionally come in and require a 10 by 10 or a longer term lease. And because of that, they adopt a percentage to that to in turn get an incentive. So they might ask for a 15% incentive over a 10-year term, which is essentially like a 1 or a 2-year rent-free period. So yes, their incentives on commercial can be large, but it's because of who is either coming in and the commitment required to get that tenancy successfully in an operational state.
So on that, for investors considering a commercial, before we talk about leases and net leases in comparison to resi, if as a landlord, what would be the better? I know it's variable because it depends how long in the term, but obviously if I've got a longer term tenant, I can be better with the incentive up front. And would it be better to give that up front so I still keep the rent as certain? Because I know based on the yield and the rent, that affects the value of my property every year going up.
Yeah, correct. Look, there's many ways that strategy can be adopted. So how we've helped protect our clients with that is we're asking X in rent. If we achieve close to what our desired rental income is, instead of adopting a 10 or 20% incentive, which in this case, for example, we've got Woolworths coming in, and instead of us giving them a 1 year or 2 year rent-free period, we will amortise the incentive throughout the term of the lease. So the landlords are getting rent up front. The incentive is amortised throughout the whole term.
Right.
It protects the vendor because he's on the lease, his capital value is protected, and the incentive deed isn't formed where he's got no cash flow projection for 2 years, right? So these are ways that we can protect the vendor in that scenario of having the incentive amortised throughout the term of the lease. And the landlord's getting rent up front. He's provided that incentive to the tenant, so it's a win-win situation there.
Because I think one of the things that excited me about commercial is that based on my yield and the yield of the area, if I'm getting a 2 or 3% rental increases, and we'll come back to what you think is the average these days, that my value of my property is going up by X amount. So I had a rental increase of 18,000 over various tenants. That on what I bought it for, the yield was 6.9, means that my asset was climbing by 250 a year in asset growth. Yep. If I sell it at the same yield, good thing where I bought in Perth, actually the yields dropped, so my value's gone up a lot more. It's now down to 6% real at the average. Because usually when people are buying in an area, there's a sort of standard yield, isn't there, for an area? And people are. Do you want to talk a bit about that when people are trying to assess the value of a property?
Yeah, so the value of the property comes down to, number one, location. The location, due to that location and the tenancy mix, the demographics, the population, all those elements will come into consideration when sort of determining how viable that tenancy will be and how can they maintain that level of rent, not just now, but throughout the whole projection of the term of the lease. So because of that, they will adopt a yield. Hence why the inner west city fringe areas are around 4-5%, and further out because of the demographics, population, and the risk association with that, they adopt a higher yield.
Yeah. And I guess desirable people want to, like, why is Manly so expensive? Example.
Correct.
Compared to maybe Mudgee. Well, Mudgee's expensive because lifestyle, but those sort of areas, people are going to pay more because they think the capital growth may happen more. But generally in commercial, the capital growth, right, for people listening is more around the yield, isn't it? Based on all those other things you said, like is there development potential because there's an extra 1,000 square metres on that parcel of land, they could build another warehouse. I know that all adds to it. But if you were just comparing, a group of shops, example, 3 shops over there and 3 over here, and one was trying to get the average yield was 4.5, but someone was trying to get 7, that's going to affect the price. So is that what investors are looking for in comparing some of those yields where it's more something they compare against? How do you find with your buyers what they're looking for at the moment?
I suppose generalizing what they're looking for.
Yes.
They're looking for sites that are providing them with in the current market conditions now, with what's happening globally. They're definitely looking for security. So that they're looking for a tenancy that, yes, is locked in 3 years, 5 years with options, more of a passive play, which means that they've got someone locked in. It's not really a development or an immediate repositioning upside opportunity. It's a tenant locked in, and you're relying purely on your annual increases, whether they may be a fixed percentage, which is usually...
On that increase, before you jump to that, what are you finding in your area, or what seems to be the norm out there from increases? Is that...
Look, traditionally speaking, it ranges between 3 and 5%.
Yeah.
And it all comes down to how the deal's been struck, right? So if someone comes in below
you
market...
need a good agent.
Yeah. If the deal comes in below market, then in my view, you should have higher increases.
Yes.
If you've struck a deal at market, then CPI is probably the most commercial approach. CPI now is climbing. So I think more prospective tenants are leaning towards a fixed percent.
Yes.
So they know what their costs are, not just today, but the projected costs for the next, say, 2 or 3 years, let's say.
Yeah. So, again, and this a little segue, but your mix of commercial buyers, so I'm sure you've got people that are first time buying commercial and people that have been in the game forever. Where are they coming from? What are the inquiries? And I know you sell all sorts of products, from very large ones to small shops, everything. What's your typical first-time investor? What do they look for? And what tips could you give them that they should be considering when they're looking at a commercial?
100%. Look, I mean, I think from my own personal experience in dealing with all these investors, I think when you're looking at an asset, you want to have the ability where it can be repositioned. And there is you want to have some form of risk, because that risk, in my view, is also an upside. Mm-hmm. So what I mean by that risk is if you've got tenancies that maybe on shorter terms, maybe 12 or 18 months, 2 years, see that in my view, that is an ability and an opportunity to reposition those leases, reposition those rents.
So you mean increase them?
Well, yeah. In most cases, that's the opportunity where you've got a market review. There's a new lease negotiation potentially around the corner where, you may have the risk of a vacancy, but it's more of an opportunity.
And that could be in the buy price too. You mean you could be more favourable buy price potentially if there's more risk?
Correct.
Right.
Correct. So you're buying it at a more competitive price.
You've got to be comfortable that if you lose a tenant for 3 to 6 months, you can carry that.
Correct. But you'll be able to identify that based on your due diligence through the process of buying the property. So, having the right people represent you and having the right conversations with the prospective tenants, which you can.
So that's an upside of going, okay, could be more things that I might be able to increase my rent in 2 years if they're shorter term. So there's an upside. Equally for people that are more conservative, go, like I know I was buying this particular property, I had longer terms. I had 3 and 5 year sort of tenants.
Yep.
So I had time, and they all had long options, but it was a mixture of 4 tenants, so I was comfortable. I wasn't going to lose them all at once, but I was really conservative, knowing that if I lost all of them, I could cash flow it.
Correct.
From my business to go, I can cash flow that and carry it for whatever for
Yes.
a year, and with no chance, I was safe. And I think you've got to think that through a bit, not just be a first time investor into
Yes.
commercial. It's where resi is really helpful getting on
Yes.
the ladder, and I think a bit of a mixture of both. I know in my particular case, being an old bugger, but I wish I learnt this 40 years ago, that you're building cash flow, and commercial and resi is like another business. Treat it like a business.
Yeah. Yeah.
It's an
Commercial's
investment
all
business.
about return on investment.
Yeah.
And I think, the return on investment is more crucial than your capital growth, because if your return on your investment is protected with respects to the lease covenant, your outgoing recoveries, you're getting your projection of growth with increases, that in turn increases your capital value anyway.
And on that, we just mentioned it, so I don't forget to ask you. Let's just segue into different leases. But first, what a lot of people don't realise is that in resi we are used to paying for our insurance for the building, paying for land tax and so on. But in commercial it's very different. So let's talk through what the tenant pays, because when we talk about a net figure, like it was 4.5 in a city, or just say it was 7% in Perth, we're talking a net figure after all those costs, generally. Yep. So maybe explain that to people listening today, how that difference from resi and what a net lease is.
So, I mean, I suppose the biggest difference in the residential versus the commercial investment is residential, as you know, you have to, the landlord absorbs all the costs of owning that asset, whether that would be from the land tax, insurance, council, water, management fees. You absorb all the costs. So once you take all that cost into account, with your whatever's left over is your true net position, which traditionally in residential can be as low as even 1.5% to 2%. Where in commercial, I would say probably in the inner west city fringe markets, it's probably a 50-50, where leases have the ability where the tenant recovers the outgoings, where you can on-charge to the tenant your council rates, your water rates.
This is on top of the rent you're charging.
Correct. So you're charging them rent, and then on top of the rent, you're charging them the water rates, the council. And in most cases, I'm seeing now insurance, because the insurance premiums are determined based on the tenant. So if you're not, and in other cases, if you're not getting the insurance, you're getting the increases on insurance. So you're still protected. And land tax in some cases is a 50-50. But regardless, from
and I know that can be different, right? It depends on the areas. In my case, Perth, I'm getting all the land tax paid by the tenant. It's different, but I guess more competitive in the inner west and different things.
Correct.
But that's a huge difference compared to residential when you're talking a net lease, right?
Yeah, massive difference. Massive. I mean, that's why your net position in commercial when you're buying is, let's say, at a bare average 5%. So you're getting a 5% return after all expenses.
Yeah.
So from an investment point of view, why would you go to a residential and get a 2% return?
I guess because you don't have the deposit. But equally, and I love resi as well, because I've been at resi. I think it's part of, we mature as investors, but it's all so cash flow.
Correct.
Right. And, you probably need to spend, for a decent commercial property, what are you looking at? 2 million plus, really, for something decent that's going to get.
Yeah, I think minimum 2 million plus.
Minimum 2 plus. Yeah. So then you've got to think, well, if the bank is lending, it depends on your assets, but just say you needed 35% equity in that, whether you draw that from your home or you draw it from other investments, you've got to have that sort of equity. So if you were starting out, where resi you can get in for, these days, 10% deposit, if you enough cash flow to fund it with your wage. So it's easy to get started, and it's simpler to understand, and there is less risk because there's in the right areas, right? There's such a shortage of rentals, and it has been ever since I've been in real estate 20-odd years, that it's easy to fill.
Correct.
And you can carry that, meaning you're not going to be without a tenant for too long generally, right? Where commercial, you've got to be able to cash flow that. But how I look at it too, and I know your clients would, is that you are building cash flow assets that can either replace your day job if that's what you wanted. There is less to manage. Yes, can be a bit more risk. You've got to be comfortable with that risk. You can get a great yield, and then you're getting that capital growth, where people think you don't get capital growth, but you do get great capital growth based on the yield.
You're getting the capital growth based on the increase of your yield.
Yes.
And then this is what I say is the cash flow position with the increase in that yield and equity growth allows them to go again. So that's how they're creating their wealth.
And I think when you get the bug, like I know I have, like I love both, but again, I love building. I got to my age, Paul, going, in the early years, you're looking at capital growth more than anything as an investor. Well, I was. Everyone would be different. I was slow to learn. But then later in life, you're going, well, I'm never, at my age, people that are going to benefit from the capital growth will be my family, I'm more interested in building cash flow now so I can have cash flow in retirement to have more holidays.
Yep.
So that's why I like commercial, but everyone's different.
Yep.
But I think that real mixture is a bit of
It's
both.
crucial. It's crucial, especially now with all the projected CGT changes in May, whether they come out or not. I mean, this may affect even more so residential, where people do own residential properties and can't pass on land tax and all those costs to the tenant. So not only
they're getting it wrong, aren't they?
So not only
that's a whole other discussion, but the government doesn't seem to listen to.
But the beauty of commercial is with these proposed changes, yes, land tax and all that may go up, but those costs are still recovered by the tenant.
Correct.
Which means your yield's still growing, your capital growth is still growing. Whether you realise that asset or not, you've got the ability to still recycle that elsewhere.
Correct. And I think the same as you were saying, you can use that increase in cash flow every year if you want to go again and buy another commercial. And the trick here, again, took me all my life to work it out, is try not to sell anything. But we all know we need to sell different properties at different times to either trade up to buy a better asset, or using it to build a business like I did over the years. But I think if the longer you can hold on to those properties and go again, there's different parts of commercial. So just jump into a couple more questions. Let's talk about leases, because for a lot of people, we're used to residential and go, okay, there's a resi lease. Let's talk about, there's a retail lease, there's all sorts. Give us a brief summary of the different leases and where they might be used in commercial.
So in commercial, you've got two main leases. You've got the retail lease.
What does that cover generally?
So under the retail lease, you've got a Regulations Act will provide your whole breakdown of what's considered a retail tenant versus a commercial tenant. But a retail tenant is predominantly your ground floor shops that you see, your cafes, your restaurants. Yeah. They're predominantly your retail tenancies. Mm-hmm. And then other uses attract a commercial lease.
And what's the main difference? Is one offer more... is it easier for a certain tenant, a retail to a commercial, or is there pros and cons for the landlord and the tenant?
There is definitely. The Retail Leases Act protects the tenant far greater.
Okay.
That's why in most cases, if it sort of escalates to a position where it unfortunately gets to a mediation and whatnot, it will go under the Small Business Commission, which is under the Retail Leases Act. So your lease then essentially becomes superseded by that legislation. So yes, retail... It protects the tenant. Commercial leases, and again, this is based on the use. So commercial is more your logistics, your industrial, commercial office spaces. They will attract a commercial lease. That lease protects the landlord. Okay. In my view, far more greater.
And obviously, if people want to know more, they can reach out to you.
Yeah.
Say, Paulie, tell me the difference. I'm thinking of this sort of investment. What lease would it come under? So reach out to Paul, and he's happy to. It's probably longer than this podcast will allow to go into it, but give you good advice on that. And it may affect the different levels of investment and the risk you're comfortable with that you want to look at.
Correct.
So if I was buying in your areas, let's say Inner Western, out there in the CBD, and I had, so what do you reckon you need to get into the safety sort of commercial? Is that 2.5 plus in those areas?
Yeah, minimum.
Okay. Let's start at 2.5. Say I'm a first-time investor. I own resi. I want to put my toe in the water. What would that sort of possibly get me into? What style of property?
Predominantly a mixed-use zoned property which has a shop on the bottom with maybe 1 or 2 residential dwellings above.
Okay, cool. And that resi is part of the price?
Yep. Falls under the whole commercial property.
So no doubt then it comes down to where it is, location, future road widening, all that sort of thing, which... your agent should be able to tell you about and give you some feedback. What would be the next level up? 5 million or 10 million? Where would you jump then to the next?
I'd say there's a bit of a gap, but I would say the next one would probably be about between 4 and 5.
Okay, and what sort of style of property?
Style of property would probably be the same. but on a larger scale.
Okay.
So you might find 2 or 3 shops on the ground floor with a couple or more residential above, or you might have more of a blue chip anchor tenant on the ground floor paying a larger net rent, which, it's a catch-22. You either go down on the one blue chip operator with a couple of residential dwellings above, or you might have 2 or 3 smaller shops.
So it's not a bad thing if you wanted to mix your bit of resi, a bit of commercial.
Yeah, correct.
So hedge your bets, so to speak, across the two. Okay, we jumped to 10 to 15. Now, the whole world will change a bit. What sort of properties are they, or would you find around Sydney that traditionally you've sold, you've seen for sale? And so on?
I look a whole variety. So again, you've got your mixed-use zone properties. So, and now you might have an anchor of shops, 5, 6 shops with maybe 7 or 8 units above. You've got potentially larger industrial sites on a couple thousand square metres of land locked in with anchor tenants. So they're good because they also offer potential rezoning and development play in the future. And then, or you might find your large commercial office buildings that you can sort of secure in one line.
So let's think of some of people you've known over the years that have been, let's say, not say hard is not the right word, but let's say smart long-term commercial investors. What are some of the plays you've seen them do that they've done well in, or that you see maybe potentially they've been great investments they've managed to jump in and buy?
I think the combination I've seen with all of them is that they're all prepared to take a risk, whether it's because they're in a position that allows them to do that or not. But they're more risk averse in the sense that they'll go in. It's a long-term projection play for them. So because of that, they know that, okay, I'm not looking at fixing this up, doing a flip. I'm holding this. I'm going to go through whatever we need to sort of endure to backfill it and secure that tenant. And then we know that in the long-term play, this position, once it's rented.
Because obviously, clearly, if they're buying something without all the tenants filled,
correct,
the increase of the value once they're rented and they've got leases,
correct,
the bank's going to put a whole different valuation on it. And not only that, if they resold it, if they happen to, now you've got all this yield has climbed. Paulie, let's talk about some of, let's say some of your more seasoned investors first, and then some new investors. But your seasoned guys, what are some of the plays you might have seen them do where they've added value and what they're quite astute at doing for those long-term plays that maybe you've seen them acquire different sites?
Yeah, I've seen them, like they're in a position where they'll look at an asset, even perhaps the asset in this case, there was one in Ferry Meadow where a client purchased it for just over $3.5 million, where it had about 13 commercial office suites and 6 shops on the ground floor. The rates on the ground floor were well under market, and upstairs in terms of the suites were well under market. He was prepared to purchase it at that level based on the data that we provided to reposition it and increase the yield. Over a 12-month period, half the building, if not 60% of it, became vacant because of the rates we had requested. But in turn, he's only got about 3 office suites empty and 1 shop now empty. So everyone else that is there now is
at a much
paying the market
increased
rent.
The yield and the value went up substantially.
So he's getting more rent than what he purchased it for, but he's got 4 vacancies still.
Yeah.
So his value of the asset has increased, his capital value has increased, the whole site's become beautified.
And he's still got room to go up with more tenants, increase the value.
Correct.
So I guess you've got to allow that you've got the time to allow and the cash flow.
Correct.
So let's go to maybe think of what some of your younger investors might be. Now that could be an old bugger like me that is still relatively new to commercial, through to younger people that are buying. What are some properties they're buying, or what are you seeing some of the deals that are doing that are good deals for them for long term?
Yeah, I think for someone looking to invest into commercial, first time walking into that sector, it's more so, in that 2 million range, for example. It's more about identifying, okay, the ground floor is a well-known covenant. They've been there many years. It's secured. They're in a lease. They pay their rent on time. There's some portions of outgoings that are being recovered. So it gives you that sense of security. And the cream on that is the residential component above.
Yeah,
so you've
I
got
like the idea of that. It's a mixture for people that are not, going from that resi space to commercial, having a bit of both. I think even at my level, I go, I like that mixture.
Yeah, it gives them the residential is the defensive side of the asset, right? Where if it becomes empty, we know within a week will be re-rented. And it's always going to provide some form of cash flow in the event that something were to happen downstairs.
Where are you finding your investors, Paul, are coming from? Is it mum and dad investors? Is it large, a mixture of everything, young investors?
Mixture of everything. But I think at least 50 to 60% would be mum and dads.
Right, okay. Just wanting better yields or returns? Or
yeah, I mean, they've saved up or they've sold potentially some residential investments and now they're looking to go into that larger commercial investment where it gives them 3, 5, 10 year secure lease with increases.
And better cash flows.
Outgoings recovered, exactly, better cash flow projection.
Yeah, and I think that's important. It's one of the reasons I like commercial. Cash flow is better for me. I can leverage. Yes, I've got to have more equity to put it in, but as that's going up every year, I can leverage on that. It's not a drain on my, as I was saying, I've got a 7% yield on a property now, but my borrowings are 6.2%. So even with 100% on a property example, borrowing on that, I would be still cash flow positive.
That's right.
I can't do that necessarily on resi. But of course, I've had to use more equity and leverage more to do that, so it's not a first-time investor. But I would certainly encourage people on your investment journey to learn about commercial. I said, I wish I learned in my 20s about commercial because I would own more commercial property and I would have more of that mixture and I would plan for that as it goes. So I'd definitely suggest to all of you, questions, send them in. We'll have Paul's details. He's happy to tell you. Educate yourself. There's a lot of books on commercial. There's a lot on the internet which will show you about that as well. And part of our journey on this education process with Stone and then this podcast is to just open your eyes to what may be possible. As often we were chatting earlier, Paul, I said when I started at 23, there was not much information on property. Eventually there was newspaper, Property Investor and all that sort of thing. Commercial didn't bubble up and show you because it was sort of like people in the know. So we're trying to lift the lid for everyone on, it's not a secret thing, but it feels like that. And we want to open your mind and then speak to people that are investors in commercial, speak to our people, speak to people that specialises like the guys at Rethink we talk about. Yep. They're just a buyer's agency business. We sell properties for landlords. But there's some great people out there who can take you on this journey, which is an exciting journey. Even if you're not ready today and you're just buying your first investment, you go, okay, well, how could I get to a commercial and what would that look like? And don't forget about it because, as we all know, every year is going faster.
Yeah, correct. And 100% correct. It's like when you're investing into residential or when you're buying residential, they say the average time it takes to buy based on how long you've been looking in the market is 12 months. So the same with commercial. If you're planning to get into commercial, I suppose let's look at that journey now because that journey can take at minimum 6, 12, 18 months until you finally get into the right one.
And I think equally, as I've often said on these podcasts, I remember when I was at school, I was not a grade A student and I was always worried about putting my hand up asking a stupid question. What I found as I've got older, you don't care anymore, you do ask stupid questions. So it's another tip I'd give you. Go and ask stupid questions, meet with people like Paul in the industry, ask questions. People don't care what you don't know, they want to help you. Ask these questions, learn, take it on, and eventually your memory bank builds up some things, like little things I remember learning years ago about commercial. Then eventually when I was doing it, oh, that's right, what about that? Life is an ongoing journey of education. We can't all expect to know everything when we come out of the womb. So enjoy this process, ask questions. So Paul, is there things that you see, any trends in your areas of particular styles of property that more investors are looking for at the moment? Is it and again, we haven't touched on this yet, but in another podcast, but industrial, there's retail and so on. But
look, in my market, there's been so much redevelopment that's occurred with changes to zonings and properties that have been allowed to be redeveloped with higher floor space ratios and whatnot. So what I'm saying, a lot of strategic assessment on certain sites, from whether they're even mum and dad investors to the larger consortiums or developers, they're looking to buy properties that fall within catchments that allow them, maybe not today, but are earmarked for 5 or 10 years to be rezoned or fall into a larger catchment for higher floor spaces and whatnot. So it is strategic, but I'm seeing a lot of that.
So you're seeing there's more more of a consortium coming together, like to buy a better property?
Yeah,
a group of investors.
Like a group of the other day we got called into a block in Petersham. There was about 10 residential houses in one line that are looking at amalgamating because it falls under a new LMR zone, which allows for an uplift of residential from your standard low density to a medium to high.
Right.
So that's a commercial target transaction, but we're seeing, because of all these changes in zonings, that they're becoming more creative with, okay, well, how do we get the most for the asset, whether that might be an amalgamation and whatnot.
Yeah, look, it is interesting how things are changing quickly across Sydney.
Yeah.
And these are some things to be aware of. You know, do some Google searches, speak to people, find out, speak to agents in the area, see what they know about it, and learn. Don't live under a rock. You know, we all get busy with life, raising kids, families, everything.
Yeah, there's a lot of changes happening, so you need to keep yourself up to date with all.
And look, thanks, Paul. It's been enlightening, I'm sure, for a lot of people that know nothing about commercial. And we'll get back on again and talk nitty-gritty about specifics as well in future podcasts. But again, anyone listening to our little podcast channel here, send us questions and we can maybe answer them on future podcasts. But it's been great today once again. Thanks, Paul.
Thank you so much, Pete.